Hey guys, Michael Stowers with Loan Depot. Thanks so much for joining us today. Our goal here is to help educate and give you meaningful information if you're a homeowner or potential home buyer. Hope you enjoy this episode. So in today's episode, we're going to talk about factors that affect mortgage interest rates. We're going to be focusing predominantly on the global side of things. There's also the financial health, which we'll talk about in the next episode, but today we're going to focus on 5 factors that make up mortgage interest rate. So mortgage interest rates have a long-term cost effect to a home buyer, right? The higher your interest rate is, the higher typically you're going to pay on your monthly mortgage payment. So now we're going to be going over the 5 factors that make up the mortgage interest rate when it goes to the global factor. So the first factor we're going to talk about is inflation. Typically, when we have an inflated economy, home prices, good prices, product prices are typically higher. Okay, this erodes your purchasing power. So let's say an interest rate that you get on your returns at 5% and inflation's at 2%. Well, the actual net gain, your true purchasing power is only 3%. So the higher your inflation, typically the less purchasing power or the lower value of the dollar has. The number 2 factor is level of economic growth. So what you're looking at here is the higher level of economic growth with gross domestic product and employment rates have a lot to do with what your interest rate is going to be on a home mortgage. So when you see a high level of economic support, you're seeing a high level of wages, your income, and then a higher level of consumer spending. When you have a high level of consumer spending, a lot of consumers are wanting to pull out mortgages to purchase a home. So mortgage rates have a lot to do with supply and demand. And when there's an overall demand of mortgages, there's an overall upswing of mortgage interest rates. And the reason for that is lenders only have a certain amount of money they're able to lend. So that's why supply and demand is very vital in the economy. In a weakening economy, the opposite is true. Income levels typically and wages are down, consumer spending down. So that is an overall downward pressure of mortgage interest rates, which is not the current economy. The number 3 factor is the Fed, the Federal Reserve. This is the main bank. Now, they don't necessarily set the interest rates on mortgages, but there's a big influence as to what happens when it comes to mortgages when the Feds change their policy. So the Federal Reserve rate adjusts their money supply, whether that's upwards or downwards, and have a direct factor on what clients can borrow. So when the Feds have an increase in money supply, typically that's a downward pressure on rates. And then when there's a tightening of the money supply, which you're seeing currently, there's going to be a higher rate that the Fed is going to be giving for banks and the public to borrow. And number 4, and I believe the most important, is the bond market. So you have the stock market and the bond market. Mortgage-backed securities are basically bundled mortgages that are sold to investors. And investors want a high yield so they get a better return on their money. We typically, as mortgage lenders, look at the U.S. Treasury 10-year yield to give us a good indicator on where the interest rates are at. But what happens is the government borrows money from the bond market, and when they do a huge sell-off, which they're doing currently, the yield typically goes higher and the price goes down, so it attracts more buyers to buy that product. So if you're looking at to invest in stocks versus bonds, typically bonds are a safer haven. So if the economy is really crazy, if there's some pressure globally, typically the bonds, a lot of investors will put their money in that vehicle, which typically the more people that put their money in the bond market, the lower rate of return, which is good news for interest rates. Bad news for mortgage interest rates is when the economy is doing really well and they put money in more riskier type of investments such as stock. So the last economic indicator is the housing market. So right now, currently, there's fewer homes being built. And when there's fewer homes being built, typically home sales are down. And that's going to put downward pressure on mortgage rates. And that's why now more than ever has been a great time to buy, because interest rates are still at historical levels. But they do plan on going up due to what's happening in the economy. So the bottom line is mortgage rates are tied to the basic idea of supply versus demand. In our next episode, we'll be talking about the financial health and the 30 different factors that make up your interest rate on a personal level. Thanks for tuning in, guys, on the global market and how it affects interest rates. Please feel free to message or call me anytime. Thank you.